Hello and welcome. Today we're going to dig into a corporate filing from Escorts Kubota. Now I know what you're thinking, a bunch of numbers, but trust me, this document tells a fascinating story. A story about a huge cash windfall, a big payout for investors, and some really ambitious plans for the future. So let's decode it together. So what you're looking at here is the official financial report for the last quarter. You can think of it like a required health checkup that public companies have to share with everyone. Shareholders, analysts, you name it. It's their official scorecard, and yeah, it's packed with data.
But it's so much more than just a report card, right? It's really a blueprint for the company's strategy. Our job today is to look past all the jargon, cut through the noise, and find the real story of what's actually driving Escorts Kubota forward.
Okay, first up, the financial report card. This covers the last 3 months of 2025. The big question is, how'd they do?
Well, the first number pretty much everyone jumps to is profit. And for this quarter, Escorts Kubota reported a standalone net profit of over 362 crore rupees. That's the bottom line, the key measure of success. And that is a very, very solid figure.
But you know, a single number doesn't tell the whole story. What really matters is growth. And as you can see right here, when you compare this quarter to the same time last year, both revenue and net profit are up a lot. That jump in profit from about 323 crores to 362 crores, that is a very healthy year-over-year improvement.
So those quarterly numbers are definitely strong, but the story gets way more interesting when we zoom out and look at the last 9 months. See, the company's profits didn't just grow, they nearly doubled, all thanks to a massive one-time event. So where on earth did that extra billion rupees come from?
And wow, this chart just tells the whole story perfectly. Look at this. On the left, you've got the profit from their regular day-to-day business, a solid 1,056 crores. But then, look at the bar right next to it, another 1,028 crores from discontinued operations. They basically made just as much money from a single one-time event as they did from their core business over 9 whole months, and that event was the sale of their railway equipment division.
And here it is, the confirmation straight from the filing itself. The board approved the sale of its railway equipment division. Now, this wasn't just them selling off some old equipment in a warehouse. No way. This was a major strategic decision to really sharpen their focus on their main business, agriculture and construction, while totally flooding the company with cash.
So you've got all this extra cash from the sale? What's the very first thing you do? Well, for Escorts Kubota, it was all about rewarding the owners of the company, the shareholders. They did this by declaring what's called a special dividend. Now, unlike a regular dividend that you might expect every so often, a special dividend is, well, it's exactly what it sounds like. It's a bonus. It's the company's way of sharing the profits from an exceptional event, just like the sale of that red business.
And it was a seriously generous payout, 18 rupees for every single share. Now, to put that into perspective for you, the original face value of one of these shares is 10 rupees. So this single dividend is a 180% return on that nominal value. It's a huge direct reward for their investors.
But just rewarding your shareholders is only half the equation. A really smart company has to balance rewarding the present with investing in the future. And that's exactly where this story goes next.
So this brings us to their plans for future growth. Because the very same board meeting that approved that big dividend also laid the groundwork for the company's next chapter. They were pivoting from past performance to future ambition.
And they made 2 really clear, really powerful moves. First, they brought in some fresh expertise at the board level. And second, they gave the green light to a massive expansion project. Let's break those down.
First, the new leadership. They brought in Mr. Hitoshi Sasaki and Mr. Satoshi Suzuki. Now, the crucial part here is that both of them are nominees from Kubota Corporation, their major Japanese partner. This isn't just a simple personnel change, it signals a much, much deeper integration and strategic alignment right at the very top.
Okay, now for the expansion. The document mentions they're setting up a greenfield project, and this is some important corporate lingo you should know. It doesn't mean they're just buying some old factory and fixing it up. No, it means they are starting completely from scratch, building a brand new state-of-the-art facility on undeveloped land. It's a huge commitment.
And here are the specifics. A new factory in Uttar Pradesh, built specifically to ramp up production of their core products, like tractors and construction equipment. This is them taking the cash from selling off one part of the business and literally doubling down on what they do best. So we've seen the strong profits, we've seen the big dividend, and we've seen the ambitious plans. Now let's try to connect all the dots and see the full story this filing is telling us.
So here's the narrative, right? The company had a really strong performance that got absolutely supercharged by that strategic sale of their railway division. They took that cash windfall and did two key things. First, they rewarded their investors in the here and now with a big dividend. And second, they plowed a huge chunk of it right back into the business to fuel future growth with a new factory and new leadership.
So what started out as just a wall of numbers is actually a powerful statement of intent. This filing shows a company that is incredibly confident in its core business, very strategic in its big decisions, and is aggressively investing to be even stronger tomorrow.
And that really leaves us with one final thought. When a company, at the exact same time, rewards its owners for past success...
We are doing something a little different today. A bit of a risk.
Oh, I'd say so.
Usually we're wading through, a stack of reports or maybe 5 different articles trying to connect the dots. Today, we're looking at a single image.
Just one. But to be fair, it's a very, very dense image.
It is. We're looking at a daily candlestick stock chart for a company called Escorts on the NSE, the National Stock Exchange. And this is from the Nuvama platform.
Right.
And the whole mission today really is an exercise in visual literacy, but for your ears.
Which is, ironically, one of the best ways to learn this stuff. If you can actually visualize the movement, the psychology in your head, you get the dynamics way better than just, staring at a screen.
That's the goal. So we're recording this on February 10th, 2026. This chart covers the last, 7 or 8 months, right up to today. And just looking at it, if you're not a trader, it looks like an EKG machine having a panic attack.
It's chaotic, sure. You've got the red and green bars, these flowing green lines that sort of envelop the price, and then that jagged white line at the bottom.
Right.
But every single pixel there, that's a human decision.
Decision to buy or to sell.
Exactly. Fear and greed right on the screen.
So let's try to untangle that mess. Let's break it down into a story. Because looking at the timeline from, say, July 2025 to now, I really do see a story with a few distinct chapters.
Oh, absolutely. It's a classic 3-act play. You've got the steady climb in the summer, then the winter choppiness, and then the crash and recovery we've just seen.
Okay, so let's start with Act 1. The summer of 2025. What was the mood there?
So if you go back to July of 25, the stock, Escorts, is trading around the 3,300 level. And for a couple of months, it's just this beautiful, almost boring uptrend.
Drifting higher.
Just drifting higher. Lots of green candles, which just means the price closed higher than it opened. And they're just stacking up. It's polite. It's orderly.
Right. Low volatility.
Yeah.
The kind of thing you want to see in your retirement account.
Yeah. Exactly. It's what we call an accumulation phase. People are quietly buying in. But then late August hits, and we get the first big plot twist. There's a massive spike.
I see that. It's the tallest bar in the chart until you get to what's happening right now. It just sticks out completely.
And look at the very bottom of the chart, the volume bars, those tiny little lines. They usually just hum along, but late August, there's one red volume bar that's a skyscraper. It towers over everything else.
Okay, so let's unpack that. Price shoots up, volume explodes. Now, I'm always told that volume validates the price move. If they both go up, that's healthy, right? It means there's conviction.
Generally, yes. But an anomaly of that size, that's often something we call a buying climax. It means pretty much everyone who was thinking about buying, they all jumped in at the exact same time. It's a frenzy.
Okay.
And you have to ask the question, if everyone was buying, who was selling to them?
Oh, the smart money getting out.
It's very likely. That spike often signals a transfer of ownership from the pros to the latecomers. Because look what happens right after that. The trend just dies.
It hits a wall. And that brings us right into Act 2, the autumn stagnation.
Precisely. From October through December, the stock basically goes into a coma. It stops climbing. It just gets stuck in this box, bouncing between, say, 3,600 and 3,800.
That's consolidation.
Consolidation or chop. It's just choppy. The market can't decide. Buyers push to 3,800. Sellers come in. Sellers push it to 3,600. Buyers show up. It's a tug of war, and nobody's winning. And this, for a trader, is actually the most dangerous place to be.
Really? More than a crash?
In a way, yeah.
Yeah.
The crash is quick. This bleeds you out slowly. You buy thinking it's a breakout, and it drops. You sell thinking it's a breakdown, and it rallies right back. It just destroys your confidence.
Until the break finally happens.
Yeah.
And it was not in the direction anyone holding the stock wanted.
No, it was not.
Which brings us to Act 3,
Yeah.
January 2026. The floor just falls out.
The breakdown, you can see it so clearly. Early January, that support level at 3,600, it just disintegrates. You start seeing these long, aggressive red candles.
And when you say long candles, for anyone visualizing this, that means the difference between the morning's open price and the evening's close price is huge. It's not a gentle drift down.
No, it's a plunge. It indicates panic, it's capitulation, it's get me out at any price. The stock just plummeted all the way down past 3,400, and it bottomed out near 3,339.
That's a 12 to 15% drop in a really short time? If you held to that boring autumn, you just watched all your gains disappear in about 2 weeks.
It's terrifying, and that's where most investors make the classic mistake. They sell at the bottom, which brings us to the twist. We are recording on February 10th. Look at the last 3 weeks on the chart.
It's a V, a sharp, jagged V. It hit that bottom and it bounced.
It's a textbook V-shaped recovery. Almost as fast as it fell, it rocketed back up. In fact, let's zoom in on today's candle. It tells a mini story all by itself.
Okay, I've got the data right here. So for today, February 10th, the stock opened at 37.97.
Okay.
During the day, it dropped to a low of 37.53, but it rallied hard to a high of 38.72, and it just closed at 323.60.
That close. 323. That is so significant. Think about where we were in that boring autumn phase.
In that 3,700 to 3,800 range, we're basically back.
We've erased the entire crash. It's like January never happened. The market has effectively said, okay, maybe we overreacted.
But that's just the what. I want to get into the how and the why, because this chart has these other lines on it, these green bands, this oscillator thing at the bottom. To me, it looks like decoration. But you're saying these things actually gave us clues.
Predicted is too strong a word. Markets are about probabilities, not certainties. But these tools, they were screaming that the odds were shifting. Let's start with those green lines. Those are Bollinger Bands.
Bollinger Bands. I hear that term all the time. The bands are tightening. It pierced the upper band. What are they actually doing?
So forget the math for a second and think of a rubber band. The middle green line, that's the average price over the last 20 days. Think of it as gravity. It's where the price wants to be.
Okay, the center, the anchor.
Exactly. The upper and lower bands, those represent volatility. They show you the statistical extremes. About 95% of all the price action should happen inside those bands.
So when the price goes outside the bands,
it's an event. It's an anomaly. The rubber band is stretched to its absolute limit. Now, look at that crash in January.
I see it. The red candles didn't just touch the bottom green line, they punched right through it. They were trading below the band for a few days.
And that is a classic oversold signal. The price had moved too far, too fast away from its average. The rubber band was stretched to its snapping point. It's a signal of statistical exhaustion.
And when you stretch a rubber band that far, it doesn't just go limp.
It snaps back violently. And that's exactly what we see now. The price hit that lower band, found its footing, and snapped right back towards the middle line. In fact, today it's well above the middle line.
So hitting that bottom band was like hitting a trampoline.
In this case, yes. It was a clear signal that the sellers were they were tired. Everyone who wanted to sell had already sold.
That makes sense.
Yeah.
What about the width of the bands? I see in the autumn they were really tight, squeezed together. Now in February, they're super wide.
Yeah, they're like a gaping mouth right now.
Yeah.
That shows you volatility. When the market is quiet and choppy, like in the autumn, the bands squeeze tight. But when the crash happened, they exploded outward to contain that huge move. Wide bands mean high risk, big moves.
So we're in a high volatility environment right now.
Absolutely. Daily swings of 2-3% are totally normal right now. You have to be ready for turbulence.
Okay, so the Bollinger Bands gave us one signal. But a good trader never relies on just one thing, right? You need confirmation.
You need confluence, you need a second opinion, and that's where that bottom panel comes in, that jagged white line.
The RSI, Relative Strength Index. Now, this, to me, it kind of looks like it's just copying the price chart. It goes up when the stock goes up. Why do I need it?
Because it's not measuring the price, it's measuring the velocity of the price. Think of the price chart as your car's position on a map. The RSI is your speedometer.
Ah, okay. So you could be moving forward, but slowing down.
Exactly. That's a concept called divergence. But in this case, the RSI is telling a simpler story of extremes. The scale goes from 0 to 100. Anything below 30 is considered oversold.
And I see the lines here, one at 25 and one at 50.50. Looking at January, Wow. That white line didn't just dip below 30, it completely collapsed. It looks like it went way below 25.
It hit rock bottom. Just like the price hitting the Bollinger Band, the RSI hitting that low level was a confirmation. It was screaming that the selling pressure was unsustainable, the momentum was just too negative.
But what's really interesting is right now, today, February 10th, that white line is shooting up like a rocket, and it just crossed that middle line, the 50.50 mark.
Yep.
And that is a huge signal. Think of the 50 line as the equator. When the RSI is below 50, the bears are in control. Momentum is negative. When it crosses above 50, you're in the northern hemisphere. The bulls have taken over. Momentum is now positive.
So we have the price back above its average line, and we have the momentum indicator confirming we're in positive territory. That's the confluence you were talking about.
That's the green light. You have price action, the V-shape. You have volatility, the bounce off the bands. And you have momentum, the RSI crushing 50. They're all telling the same story. This recovery is real.
There's one last piece, though, volume. We talked about that skyscraper back in August. What about this recovery? Because volume is the fuel, right?
Perfect analogy. And looking at the volume in February, it's interesting. It's not explosive. We aren't seeing skyscrapers. But it is rising. It's definitely higher than it was during the Christmas lull.
So it's not a fake out.
It doesn't look like it. If the price was shooting up on tiny volume, I'd be very worried. That would mean it's just drifting up because no one's selling. But here, we see participation. Real buyers are stepping in.
Okay, let's put it all together. Let's synthesize this. If I'm a listener holding this stock or maybe thinking about it, what's the story this chart is telling me right now?
The headline is resilience. The market had a massive test of faith in January. It asked, is this company really worth less than $3,400?
And the answer was a pretty loud no.
It was a violent rejection of those low prices. Smart money came in and bought aggressively. So now we know there's a floor down there. There's real demand.
So we're not down there anymore. We're way up here at 38.23. We've rallied, what, almost 15% in just a few weeks. Is the easy money gone?
That is the million-dollar question. And this comes back to the Bollinger Bands. Remember, we said the price tends to stay inside them?
Right.
Well, look up. The upper band is sitting around 39.93. We're at 38.23 a bird. So we still have some room to run, but we are getting closer to that upper limit.
And just like hitting the bottom band could cause a bounce up, hitting the top band could cause a move down.
It often does, or at least a pause. It's called mean reversion. The price just ran a sprint from the basement to the attic. It usually needs to stop and catch its breath.
So buying right now at 38.23, you're buying a stock that's already had a huge run. It's tired.
You're buying momentum, which is a good thing, but you're buying extended momentum. The risk-reward isn't as good as it was 2 weeks ago. 2 weeks ago, buying felt terrifying, but the technicals were on your side. Today, it feels safe, but the technicals say we might be due for a rest.
That's the paradox of the market, isn't it? When it feels safe, it's risky. And when it feels risky, that's often your best entry.
It's completely counterintuitive. It's why so many people lose money. They wait for the all-clear signal, which is usually right before a pullback.
So for our listeners, what's the big takeaway from this, besides, don't panic sell?
I think the takeaway is that context is everything. If you just saw the price in January, 9–10%, you panic. But if you saw the chart and saw lower Bollinger Band plus RSI below 25, you see opportunity.
It's about using these tools to put a number on your fear.
Exactly. The chart doesn't care about your feelings. It's just measuring supply and demand. And right now, the chart of Escorts says demand has returned, the crash has been canceled, but we're approaching a speed limit somewhere around that 4,000 level.
A speed limit. I like that. So watch that upper green line.
Watch it like a hawk. If the price hits that 39.93 level and the RSI is way up near 70 or 80, you need to be very, very careful.
Before we wrap, I want to leave everyone with one final thought. We love a V-shaped recovery. It feels heroic, but isn't it also kind of unstable?
It can be. It often is.
Because you didn't build a foundation, right?
Yeah.
You just touched the bottom and took off. It feels like building on sand.
That's the big fear, the dead cat bounce fear. Now, this looks stronger than that because the RSI crossed 50, but you're right to be skeptical. A fast rise is often followed by a retest. So don't be surprised if the stock drops back to, say, 3,600, just to see if the buyers are still there.
To double check.
The market loves to double check. It wants to know, are you serious about this price? Or was February just a fluke?
So if you see a red week next week, it doesn't mean the world is ending again. It might just be the market doing its due diligence.
Precisely. A pullback that holds is actually healthier in the long run than just a straight lineup.
Fascinating. It really does change how you see those numbers scrolling across the screen. It's not just data. It's a psychological thriller.
Once you learn to read the charts, you can't unsee the story.
Well, I think that's plenty for everyone to chew on. We've gone from a boring summer to a chaotic winter and back again.
And we landed right back where we started.
Funny how that works. That's all for today's deep dive. Watch those bands, check your speedometer, and don't let the red candle scare you. We'll see you next time.